get a bit of a trader's perspective right now. Michael Palmer is a volatility trader at Group 1 Trading. He's at the Chicago Board Options Exchange. So, Michael, yep, we've got another day up here. I think up 5 out of the past 6, up 2 in a row here. But the volume again, and I know I beat this like a dead horse here, but, I mean, how much do you buy into this upward move, especially when the volume is so light?
You know, you're right. It's light volume, and we've had this moderate rally, so it's easy to be lulled to sleep. But there's still a lot of unresolved risks out there. We have Japan, we have Portugal, we have obviously Libya, and all these are very different and very difficult to price situations. So with all these unresolved risks out there, there's a lot of complication and there's a lot of kind of nuance to them, and there's no real headline risk to look for.
All right,
so we're having a problem trying to say, well, what's really going to move the market? There's no real headline we're looking for.
Welcome to the show. Welcome to the close here on Street Smart. Thanks for joining us. Let me ask you about what Mike was just saying. I mean, as far as risks are concerned, you say one of the biggest ones is that people aren't that worried anymore, right? Because everybody's bullish on Japan. We all watched the slow destruction of the European Union without really being terribly concerned about it. And Saudi Arabia looks pretty strong, so no big deal in the Middle East.
I think we got to take all those separately. I mean, Japan obviously has been a horrific tragedy. When we think about the parts of the Japanese economy that's been really devastated, it's 5 to 7% of the economy, and the other 93 to 95% is intact, barring any further problems with the radiation out of the nuclear plant. But that's an important dynamic. We have to put that in perspective. You know, and again, I don't want to minimize the human tragedy. If you think about the Middle East factors, again, not as dramatic unless oil prices really go nuts. And they're up, but they're not up as dramatically as I think any one of us would have thought if we were sitting back in December, given the turmoil. And part of it is stability so far in Saudi Arabia. The third thing, which is Europe, Northern Europe's doing very well, Southern Europe's doing relatively poorly, and they're offsetting each other. And even the fears that we all had probably in December of last year about Portugal, about Spain, is part of the reasons for some of those markets coming back that was very, very priced in.
Well, and clearly the voters in the countries that are doing very well are sick of carrying the ones that are weak, right? I mean,
they are, and at the same token, you know, this has been important for their ability to continue to export and add jobs. So Germany, for instance, suffered, if you want to think of it, through a currency depreciation when you had the West German, East German unification. They had another one when the euro was formed, and then the weakness has actually helped them keep their people employed. So it's, again, politically it's not well understood, but economically it's very well understood.
I just think, you know, it's interesting. We have a special on black swan events, and we talk about the market turmoil that they've caused, right, and what tools you need, you know, to deal with it. But really, we're up 6%. I mean, the tool you need is buy the S&P and go do something else, right?
Not too shabby. I mean, it just
well,
keeps going
it isn't
up.
too shabby. And you know, we thought the market would probably be strong in the first half of the year and then probably run into some trouble in the second half of the year as things like margin compression started to come about. We're talking about margin pressure, but not actually compression yet. We're worried about QE2 coming off. We're worried about, as we get closer to the beginning of the election season late this year, that this will probably cause some ripples, because our biggest problem is budget issues.
Listen, something Matt and I have been hammering, and that is QE, and whether or not we get QE3, QE4. I mean, everybody we seem to talk to at this point, Tobias, say there's going to be more quantitative easing by the Fed.
Bulls or bears,
yeah,
everybody says
everybody seems to weigh in. Do you not
well, our
think
economists are thinking there is no QE3. I would tend to agree with them. The QE2 has been an unqualified success. It's done two things. It's
unqualified success.
Yeah, it's
even with the weakness in the housing market.
Even with the weakness, it wasn't directed toward the housing market specifically. Housing market has other issues in terms of inventory and foreclosures that have to be.
What did it do? Because
absorbed.
A lot of folks also say it didn't create
Food
jobs.
prices are higher.
Well,
gas is $4 a gallon here.
I'm not getting into the debate if that's caused commodity speculation or not. Talk to Mr. Bernanke. I think he has some very firm views on that. But I think the bigger issue is it's kept corporate credit costs down. In other words, with money going in bond markets, it's kept these yields down, and that's important for cost of capital for business to go invest. We've surveyed 700 plus companies in the U.S., publicly traded, non-financials, looking at about an 11% increase in capital spending this year. That's an acceleration from less than 6% last year. You've gotten corporate risk-taking coming back. That will turn into jobs as well. And it's also boosted household wealth through driving markets up. And that's hugely important for wealthier consumers who own stocks, who also account for a bigger bulk of discretionary spending.
So hang on, we're separating here Main Street from Wall Street. You see the possibility of a correction as still out there, right, as far as the markets are concerned?
We could be looking at things like the traditional summer swoon and things like that. But
you think we will build jobs, continue to build jobs? I think we've done 4 months in a row
here. And the market's going to be okay when the Fed says that's it, we're done?
Credit conditions lead capital spending, industrial production, job creation, and GDP by 9 months, and credit conditions have continued to improve. So that's where we think it's, and this is what told us in 08 that we had a problem. It's now telling us we don't.
So what's the snag out there? I mean, what's the thing that changes your opinion here?
My biggest concern is the government fiscal position. You were talking about before about corporate earnings are good and maybe they're better than government's position. I think that's true. Mm-hmm. At some point, we're going to have to get serious about our fiscally unsustainable path.
I have to ask you about the QE2 comment because my inbox is now flooded with comments. QE2 is the biggest Ponzi scheme in the world. And you know, someone writes in with a comment that makes a lot of sense. If you're rich, or a corporation, QE2 has been a success. If you're middle class, your home price has dropped, gas and food prices have gone up. It's not a fantastic position to be sitting in.
Let's kind of look at data over time as opposed to in just a very, very localized period. If you look at home equity as a percentage of total household net worth in America, it's 15%. 15. Mm-hmm. The other 85% is sitting in stocks, pensions, 401ks, that kind of stuff. And insurance, pension, life insurance reserve policy, all these kind of things.
But that also got hammered.
It did, and that's the point. When your 401k becomes a 201k because the market's been cut in half, the fact that we've had a market rebound over 90% has restored that wealth. Now, the top 20% of income earners in America account for 40% of U.S. consumer spending, 50% of discretionary spending, and they own 90% of all stocks. We don't have an equal distribution of wealth. We don't have equal distribution of spending. We don't have equal distribution of income. And while we can belabor that point to death, I think
it's not new.
It's not new. They tried to get the equality back in 1917 in Russia, and it didn't work.
Right.
Tobias, what's your view on the financials right now? There has been so much concern about where the future growth for the U.S. financial sector is going to come from. Do you see that kind of growth? Does this kind of give a good boost of confidence for the banking sector?
I'm not sure talking about being saved by a government largesse is necessarily a boost of confidence, but I think the fact that we ran into kind of a period of illiquidity and the government stepped in to respond to that liquidity and taxpayers come out with a profit is comforting. I think the bigger issues are what's going to happen to things like the Durbin legislation on credit card fees or debit card fees for banks. I think the issues on how this whole thing with prop trading plays out, the so-called Volcker rule, and how investment banks can be making money in the future. I think the insurance side has been actually doing fairly well and continues at the place we like. But you have to break up financials when you think about it because the regional banks are different than the very deeply capital market sensitive ones, and then insurance is in its own little world. So, I think when we talk about banks largely, we tend to confuse that a little bit.
How do you think this plays out? I mean, we have been hearing from Jamie Dimon today. Alan Greenspan kind of lit into Dodd-Frank and Paul Volcker in his FT commentary today.
You're laughing.
Do you think
I'm not sure I'm the most qualified person to respond to it.
Do you think the lobbyists get what they want here?
I don't know. I mean, I have nothing but admiration and respect for Jamie. I worked for him when he was at Solomon Smith Barney. He's an incredibly talented executive, and I think to a certain degree because his company went through the least pain of most, he probably is the person who can respond to the government programs with the least amount of kind of quote-unquote bias. Greenspan is still, I think, trying to protect some of his own reputation issues that have come under some fire. So, do I think some of the legislatures are getting the understanding that you can't shut down the U.S. and if you do, some of this stuff's going to move offshore. It won't stop. We'll just lose business in the U.S. I think that message might be getting through.
Hey, just got about 40 seconds here. So, Tobias, based on your outlook, where do you think investors should be putting money at this point?
Capital markets, some of the capital market sensitive areas like diversified financials, but we also like capital goods, technology, equipment and hardware, not across the board. We tend to be industry group focused, and consumer services we like a lot, which is think of restaurants, leisure activity, hotels, casinos,
because the consumer's
lines.
Feeling okay.
Yeah, but I wouldn't be taking that to retailing. Stocks don't trade necessarily the way fundamentals play out. And we buy real stocks, not business fundamentals.
I'm going to write that up and frame it.
No, you don't buy business fundamentals. You buy a stock, which is different.
All right, Tobias, thanks so much for joining us. Tobias Levkovich.